Hi, honey. Yes, this is Scott Barnett, and this is Rick Miller, and they're here tutoring me on the nuances I need to learn. Rick?
Well, good morning. Yes, I'm Rick Miller, and we're with Ultra Agent Insurance Services, and we kind of view ourselves as ultra safe financial services because that's what we really deal in. Both Scott and I are boomers, and we are kind of ourselves through the growth period of our financial affairs, and we're very, very interested in the preservation aspect of everything that we've done through our lives. And so we kind of view ourselves as being in the same place as most of you, in that we want to make certain that when you retire, the money that you've been able to accrue through your lives, you're able to keep. And so one of the things that we are very involved in are safe money concepts that do involve annuities. You want to stop there and then we can...
Okay. We're still rolling, but that's okay. We can cut this out. All right. So, Mary, you need to follow up with a question to Rick or Scott.
How does an annuity work, Rick?
All right. Wait a second. All right. You guys ready?
Yeah.
All right. Go ahead.
Well, go ahead.
Scott, say that again. Or Mary, just...
Yeah.
Or Scott.
Yeah, go ahead and ask him that.
Rick, I really need to understand better how this annuity can work for my clients.
Okay, that's a good question. I think that the easiest way for me to explain how annuities work is most people understand life insurance. They know that if they, a stroke of a pen and they pay their money, they instantly create a very large asset based upon what they're purchasing. When that person dies, there's a sum of money that comes in, death benefit, okay? An annuity is somewhat the opposite of that. It's where you take a sum of money, you give it to an insurance or an annuity company, then based upon your age and interest income, etc., the actuarial tables that the actuaries will then systematically calculate how much they can pay you for the rest of your life. And
lifetime income?
Yes, Scott has an additional explanation of how that works.
Well, the annuity contract is favored by the tax laws as part of government policy to encourage people to save. Except this is something you can do between yourself and one company instead of having to worry about a 401k plan or pensions and things of that nature. But the aspect of it is that when you get an annuity and you're receiving payments, you get a tax-favored distribution because the government will recognize that part of each payment that you receive is really a return of your own principal. So when you get an annuity payment, when you calculate your income taxes, only a portion of it's going to be taxable, attributable to the interest that's been earned on it. Also, and this is very interesting, when we're in our retirement ages and taking Social Security, I think we all know a significant part of our Social Security income is taxable. However, if your income is tax deferred in an annuity, if you're doing a deferred annuity, that portion will not be included in your income that affects the calculation of how much of your Social Security is taxed. So there's a number of tax benefits in an immediate annuity, and then there are all sorts of other kinds of annuities that the insurance and annuity companies have been created with that help you accumulate income before you're ready to annuitize, to make the decision that this is the amount of money I'm going to get every month for the rest of my life.